Well, hello and welcome to Trading Blows from TraderX. It's another busy show this week and a monster week for the financial markets. Plenty for myself and the panel to get into, including the Fed, the ECB, the Bank of Japan, the inflation numbers out of the US, a data deluge here in the UK, some stimulus coming out of China, and much more besides that. So without further ado, let's roll the titles and get into the show. So plenty as always for us to discuss. Let's meet the panel, as always, going head to head over 4 rounds. You know the drill by now. They will score points for a great response. The better the response, the more points they will score. And if any dispute is raised over their answer, then they have the threat of points being chalked off. Joining us this week, Richard Matthews, the senior broker at deliverable FX firm Pardus FX. Arno Venter from down in South Africa, market analyst. And last but by no means least, Ioan Smith, the market veteran of the sell side and his own research firm. With that said and done, let's get into the first round. So, round one, I want to talk about the UK. Dick, I know you're not in the city today, so I thought I would bring a flavour of the city to the show and present your favourite person here. As I'm sure we can all recall, Mr. Bailey, as it says on the front of the City AM there, told us about 18 months ago not to ask for a pay rise. Well, it seems most people ignored him because, according to the labour market data that we had out on Tuesday, UK earnings grew at effectively a record pace if you take out all the distortion around the pandemic. The labour market, very, very tight indeed. Markets now see a 6% bank rate as basically a coin flip. Mr. Matthews, let's get your blood pressure nice and high early on. What are your thoughts when it comes to the UK, the BOE? What's going on? How stuffed really are we?
I'm very relaxed about it all. I'm so relaxed. I'm just waiting for the wooden spoon to be presented before I give my first answer. I also, there's a great headline on City AM, isn't it? Really, just sums it all up. And his other great comment was that inflation persistence. They're building more into their forecast now. I've been saying, God knows for how long, the base rate should be at least 6%. You all laughed at me when I said it. I seem to think some way back, I still think it should be at least 6, if not 7%. But inflation is starting to get a little bit baked into the system and people's way of thinking. I think that it takes a long, long time for people to get it out of someone's mind. Oh, prices are going up. They're going to carry on going up. And I think that just pushes everything up. You've got strikes still going on. I think the junior doctors are looking for 35%. Lovely pay rise, which is a little bit unfair on them because it's spread over a number of years. But, people are pushing for pay rises because prices are just extraordinary. I've said it before, you go shopping, I noticed it, I'm sure we all notice it. So it is a major problem. Whether they will actually act, I don't know. I'm not convinced by the Bank of England. I think they've been pretty feeble. I think the government is as bad. Sunak, I notice, is suggesting that people get help with their mortgages. Well, they borrowed money to make money. And if the market goes against them, tough. It never bailed me out on any bloody positions I've had when they've gone wrong.
Not that he's bitter at all.
Not that I'm bitter at all. No prime minister's bailed me out of any positions I've had, and no one should. You should tough it out. I think it's a big problem in the country. I think the spat between Sunak and Johnson sums it all up. I think you're going to say, oh, you're always saying how old you are. But my feeling is that we should just sit down and say to people, you've got to tough it out. As John Major said in 1989, and I'm no huge fan of John Major, or Sir John Major, I should say. He said in 1989, when he was Chancellor, if it ain't hurting, it ain't working. And no one has got the cojones to say that these days. So I think the Bank of England's got to carry on hiking until we hit a recession, unfortunately, which we can't be far off. Looking at the GDP this morning, another asthmatic snail's progress there. So I just think the outlook's dire. I think gilt's pushing ahead, the yields going up. Are people starting to worry about an election coming on? The only good thing is a lovely sunny day, and I'm looking forward to a lovely swim this afternoon. That's the only good thing I can see about this.
I was going to say, we are being treated with the weather at the moment, and we're right. It is probably the only bright thing about the UK at the moment. The ONS, actually, if you look at the press release they put out with the GDP numbers, there's quite a nice chart in it which shows that just abysmal, I was going to call it growth, but it's not even growth. It's just stagnation, where the economy's grown nicely, collapsed over COVID, recovers quickly, and then it's just flatlining. It's a rounding error either above or below zero every time the GDP number comes out.
It's really, really strange, because they've always got a reason for it. Oh, there's been a 4-day bank holiday. Yeah. Oh, that's why it's so poor. Okay. Well, why don't we just stop having weekends? And that would
it's strike days as well.
Sorry.
Yeah.
It's strike days as well, right? So the amount of strikes there are, that impacts output as well. So that's.
Yeah, no, of course. Ioan, seeing as you're there, what are your thoughts on UK PLC at the moment? Are you a little bit more optimistic than Mr. Matthews down on the south coast there, or are you joining the pessimist society at the moment?
I mean, UK-wise, I'm more bullish. Well, not more bullish, but more constructive. I mean, like he said, given the clown show that we're dealing with at the moment from a political standpoint and a policy standpoint, and then the Bank of England, the economy is doing quite well. I mean, that's despite 2-year gilt yields hitting 15-year highs. Sorry, and I mean, that's exceeding the spike from the immediate aftermath of the mini budget. The only not the only concern, but one of the concerns that I have is where all these fixed mortgage rates are going to go. I mean, the 2-year fix is now nearly 6%. I'm not sure interest rates should be up at 7%, like Dick said. I think yes, we did need higher rates, and we've talked about it on this show before how the velocity is hurting people now. But I don't know. I think 6 to 7% interest rates would just mean a collapse of the economy, and it's a lot, and that's going to be a lot of pain for people caught in this, Bank of England rate trap. I mean, like Dick said, I mean, if 7%, I think that you have to distinguish between creative destruction and wanton destruction, and that's the point where we're at now. I know a lot of people that will suffer when their mortgages roll over now and they have to, go shopping for new deals. But I mean, we talked about this before as well, how some people have thousands of pounds put on their monthly mortgage payments, because we've essentially gone from 1% to 5%, in the blink of an eye. But I mean, we've got to remember, that, the policy, the rates themselves, they do affect, credit creation and asset prices almost instantaneously. But for it to impact inflation, it takes months, even years. So, I mean, hikes from here, they're probably going to be pushing on a string a little bit. Inflation should come down. We're coming up against tougher annual comps as well. I mean, the Bank of England themselves are expecting deflation in 24, 25. I mean, which is funny because that in itself is as much of a break in their mandate as the current inflation that they've caused. So I don't know. I think they just follow the Fed from here. But interestingly, I mean, looking at the level where the pound is, I'm looking at a daily chart over the last couple of years. I mean, this level is really interesting. We're up against resistance of, around 126.40 from, May of last year. If we break that, we could easily shoot up to 130, and then we're having a different conversation altogether.
Yeah, I totally agree with that. I want to get Arno's thoughts on sterling in just a second, because it is an absolutely pivotal level, as you say. Your point on mortgages, I'm going to get this number wrong, but I was digging into that a couple of weeks ago, and if you go back on my Twitter timeline, you'll see I put a post out about it. I think it's something in the region of 1.6 to 2 million mortgages that were fixed at a rate of below 2.5% are going to need to be renewed between now and the end of 2024. And, even if you fixed at the top end of that range, you're looking at your rate doubling at the very, very least. And if you fixed your mortgage just after the pandemic hit in 2020, you're in a whole different world of trouble. And I think you're right. There is going to be a hell of a lot of pain coming down the road as those mortgages roll off in the back end of this year and also into next year as well. Arno, let's pick up on Ioan's point in terms of the pound. Obviously, it's all kind of doom and gloom here from a macro point of view. No growth, the labour market's too tight, inflation's too high, et cetera, et cetera, et cetera. But sterling is just kind of shrugging its shoulders and rallying regardless. So 126, 126.40, can we get through it? Can we build a bit of a sustainable rally here?
Well, I mean, when we look at cable, there's obviously the dollar equation we need to keep in mind as well. So I think if you look at sterling in the aggregate, so across all of the majors, that we've been bullish on sterling, especially versus the euro since February, right? Where we've been looking for downside in euro sterling. But, following the most recent CPI print, I have to admit that I'm a bit more cautious on the currency right now than I was just, a month ago still. In a normal environment, higher inflation that leads to higher yields, that leads to higher interest rates are supposed to be supportive for the currency. We all know that. But in the current context, I just think that the picture is getting a little bit too bleak for where sterling is trading right now. I mean, we've got core CPI at 6.8%. We've got food inflation that's jumping through the roof. We have the mortgage issue that you guys mentioned, where a lot of people will need to refinance, and that's going to be a big problem in the months ahead. You've got interest rates at 4.5. A lot of the lag of those interest rates still needs to make its way into the economy. You've got short-term and long-term borrowing costs reaching very similar levels. I think the twos past the levels we had for the mini budget. So, if it was negative for sterling back then, I struggle to see how it's a very big positive for it now. We also, interestingly, we've been looking at the City Economic Surprise Index recently, and that's been starting to roll over and move in the wrong direction. And I think that's showing that a few months ago, we knew that the markets were way too pessimistic on UK data, and they continuously surprised to the upside. It looks like now the tables have turned, and they might have been becoming a little bit too optimistic now, and we could start seeing that rolling over, and that could pressure the currency as well. So I'm struggling to be very constructive on the economy and sterling right now. Even though sterling has obviously done really well, I think there's greater downside risks in the intermediate term based on interest rates compared to upside risk from here. And think about it this way, right? The markets are now, let me just quickly double check this. The markets are now at 5.72% priced by the end of the year for the Bank of England. Now, if we consider that from the current level where we are at 4.5, that means markets have already discounted about 5 hikes, assuming they go a quarter percentage point at a time. So 5 hikes already priced in. It just seems a little bit too over-aggressive right now, considering, if you take a look at the recent votes and how we've seen some dissenters already. Now, of course, the voting dynamics can change, and it will change in the next couple of weeks or so. But will it change enough to allow the markets to realize another 5 hikes? Right now, I just can't see that happening. And when the markets are pricing in so many hikes, when they're so positive, I get a little bit cautious here for sterling, because I think there's greater risk that the markets are disappointed by the Bank of England or disappointed by the data. And it's easier, I think, for us to price out rate hikes from here than to price in additional rate hikes from here. And I think that's a risk for sterling in the intermediate term. So I wouldn't want to be, we were long it from Feb. I don't want to be long it right now.
No, I personally, I would tend to agree with that. I don't see the attraction of the pound at all at the moment. Just one last point on the UK before we move on. You mentioned rate pricing. I think just mechanically, it's not impossible, but it is going to be very, very difficult for the BOE to get anywhere near that 5.75%, 6%, 7% number, because it seems unlikely that they're going to go back to 50 basis point installments. I mean, they're struggling at the minute to muster up enough votes to get a 25 basis point hike, with Dick's favourite Tenreiro and Dinger in the mix as well. So if you assume that they keep going at 25, if they're going to get to 6%, that means they're going to hike at every meeting between now and February 2024. The economy is going to have gone down the drain a long time before then, if they're going at that pace, you would expect.
Just one point on that City Economic Surprise Index. I think we should caveat that I mean, this is usually a cycle, right? I mean, expectations do rise, basically as a result of improving data, or in fact how wrong forecasters have been. So maybe we need to bear in mind that, you know, this is generally a cycle. Forecasts generally tend to change then, so we need to assess where we are in that cycle before we make any decisions based on where we are then.
Yeah, absolutely. And the other thing with the City surprise number, sorry, I was just going to say before we move on, the other thing with the City surprise number is, by definition, the way the index is calculated, it is a mean reverting index. So, Of course, we need to bear that in mind as well. In any case, let's get on to the second round. Right, US inflation, the headline number came in a little bit cooler than we expected yesterday, 4% year on year. And I was reading on the way in this morning that that's the 11th straight monthly decline in year on year inflation. So disinflation very much starting to become a more established theme in the United States economy at the moment. Core inflation also coming in a little cooler as well at 5.3% year on year. Now, before I ask you these questions, I should caveat we're recording this around sort of midday on Wednesday. By the time you watch this, the Fed are going to have announced their decision, so things could be very, very different. But Arno, what are your thoughts primarily on not only what this does to the Fed? I think we all know they're probably going to skip the meeting later on today, but also this divergence that we're seeing between headline prices coming nicely lower and core inflation remaining very, very sticky.
Yeah, I mean, you know, if for me, I think the most interesting thing right now, you know, the divergence is less of a concern because you often tend to see core track headline, right? We saw headline rip higher, core followed it. You know, the fact that headline is pushing lower, I do think that means that eventually we're going to see core catching up. So I'm less concerned about the divergence that we've seen between those two. I think something for me that was the most interesting thing yesterday, apart from that, was I thought the market's reaction, at least some markets' reactions, were quite confusing, to be honest. You know, for equities, it made sense. The rally made sense because, you know, like we mentioned last week, anything shy of a print above the prior numbers would have meant continued, like you said, inflation deceleration, and that's what we got. So, you know, the fact that we came in just below expectations was good enough for a rally. So equities made sense. For the dollar, I think the initial fall made sense. The bounce from 103 also to some extent made sense. I mean, 103 is a massive, massive level for the markets, multi-year level going back to both 2020 as well as 2016. So that makes sense. I think the markets that was a little bit confusing for me yesterday was yields. You know, it initially pushed lower, as I would have expected to see on the back of that type of headline print. But then it rallied hard after we had the Wall Street Journal comments coming out from Timuro saying that potentially, you know, the Fed could be signaling in a hike for July. Now, yields rallied strongly after that, and the move, in my opinion, just doesn't make sense right now. And, you know, firstly, yes, penciling in a July hike is hawkish, but the markets were halfway there already before CPI. Now, and interestingly, money markets actually lowered their terminal rate expectations for CPI. It didn't pick back to it didn't push higher post CPI, right? So if yields rose purely because of those comments, it would have been strange that money markets didn't follow suit. Also, in terms of inflation, and I think this is very important for, you know, the divergence between headline and core debate, is that if you take a look at a 5-year break-even inflation rates, they've been very, very close to, I think, 2%. Let me just double check here. They've been very, very close to 2%. Yeah, very close to 2% for the last couple of weeks now. And I think that is despite, you know, seeing some more stickier core inflation print. So that for me shows that markets still think that the Fed will solve inflation, will solve the problem, you know, in the next couple of weeks. So if break-even inflation moved higher, I would have understood if yields followed suit. But the fact that break-evens basically stayed where they were, money markets didn't really trade higher, And in fact, they traded lower after that. I think the move in yields for me was a little bit of a surprise. I don't know what the markets are trying to tell us there, or maybe one of the panelists can share some views on that. I think given where break-even inflation is trading, that tells me that the markets think inflation will be solved, even though we've had core inflation staying a little bit more sticky over the past couple of prints. And I think, growth will potentially run into problems in the months ahead as well, which means I think the path of least resistance for yields are more skewed to the downside than they are to the upside. But, price is always right. And right now, it's proving my assumption of what it should have done wrong. But I don't think that's based on the divergence between headline and core. If the markets were truly concerned about core inflation, I think we would have seen break-even inflation rates rise, and we just didn't. They're still very close to the recent lows. So I don't think it's the market sees it as a problem, but that does, for me, pose a question on why we saw yields to react the way that it did yesterday.
Yeah, I agree. It was very counterintuitive, to say the least. Ioan, can you try and shed some light on what may be going on there? Cooler than expected inflation, Treasuries should rally, but the 2-year traded in a 20 basis point range and ended the day about 10 bips higher. So what's the message?
I think, as we mentioned a few weeks back, I think we'd already had sort of expected US inflation to come off the boil a little bit, and all these rate hikes have been priced in. I guess we'd all expected this hawkish hold for sort of this month. Dick expects one next month, I think, don't you? But then again, I mean, that less aggressive Fed sort of feeds into that risk appetite. But like going back to Arno's point on Treasury yields, I think there's something big underlying this that that people maybe aren't talking about. Again, with the debt ceiling, I think there's a lot of machinations surrounding that. So, I mean, in effect, that's been resolved now, and the Treasury has to sell, a large amount of T-bills to replenish that Treasury general account. But I think there's nearly 100 billion in coupons that are sold this week or will be sold this week. And there's a corporate tax date involved as well. So the net effect is sort of like financial net tightening of financial conditions. But there's one thing that the media hasn't really picked on is that there's a return of deposits as well. I mean, deposits have flowed back into US banks. I think cumulatively it's about 160 billion. But I mean, going back to the other points we were making in terms of, the sort of unseen factors that are sort of generating movements in treasuries themselves. The Yellen was questioned recently in the Treasury Select Committee about, if there was an escalation in Chinese Taiwan scenario where the Chinese would end up dumping $860 billion worth of treasuries in sort of a response to sanctions, whether they prepared for that. She basically didn't answer it, but I think it seems that what they're doing now is they're sort of restricting dollar supply. I mean, you take for instance these crypto exchanges. Well, they're going after all the crypto exchanges, so they're basically forcing people to liquidate so that the dollars can't be exported overseas. I don't know; it's a theory, but and by raising rates, and they have over $2.5 trillion in reverse repos waiting in the wings. I think there's a lot more going on in treasuries than meets the eye, to be honest with you.
Yeah, I mean, it's a complicated market at the best of times.
Yeah.
We've got all of this stuff going on around it as well. Dick, you reckon the BOE should be getting to what, 7%, 6%? You said earlier. Where do you reckon Powell and Co should be getting? Can they just take a victory lap and put their feet up for 6 months?
Wouldn't that be great if they could? We'd all be happy. I think the stock market's almost there, isn't it? It's all over. If they skip today, which despite what I was saying yesterday, I suspect they will. I guess there's a 1 in 10 chance that they hike. I'm not convinced that it's all over. I actually think they still will carry on tightening. I think you'll see 6% by the end of the year, and it will stay there for a long time. And I don't mean months. I think interest rates are going to stay high for the foreseeable future, for a couple of years at least. Back where interest rates should be. Forget all of this zero interest rate policy nonsense. The core is interesting, isn't it? All over the world, core seems to be very, very sticky. And whether that's people's expectations, as I was saying earlier, that we've seen inflation, it's stuck there. I'm going to buy this now because I can. It could be one reason. Food inflation's still there. There's some problems with food supply. I think this summer with wheat looking pretty tight. So I think we're a long way from it all being over. I think Powell will come out and be a really, really hawkish press conference. And the danger is that, if they do skip or they pause, that people go, that's it, it's all over, we're off to the races, everything's fine and dandy now. And I think that's the last thing that he wants to do. The dot plot could be quite interesting. I'm no fan of the dot plot. I wish they'd just forget about it and let markets, just forget about dot plots and whatever. I think that could be an interesting thing to watch out for tonight. And just going back to what Ioan was saying about treasuries, it really, really is interesting with the amount of issuance going on. It's hard not to see that impact rates in there, but the number that they're talking about coming out. So, whether that sort of puts a lid on the economy as well, I'm not sure. But it still looks great, doesn't it? It's still holding up. Not that many signs of a recession coming. So a long way to answer your question. I think we'll still see 6. I think they'll carry on hiking until you see unemployment touch 4.5%.
Blimey, you're a bundle of joy this week, aren't you, Mr. Matthews? Let's see if you can be
a lender B.
Well, that's very true. Let's see if we can be a bit more positive about the ECB in a second. Yes, I think those groans rather sum it up. Now, I've got to say that actually I think the panel, Arno excluded, are probably quite looking forward to Thursday lunchtime, not because the ECB are meeting, but because we're all going out for lunch together. Nevertheless, those of you who are going to be watching the ECB, we should probably discuss it anyway. Arno, let's go to you first, actually. Give Mr. Matthews some time to cheer himself up, hopefully. It'll be pretty straightforward, right? And you're not invited to the lunch either, so you're going to be holding the fort for us all. It should be straightforward, shouldn't it? 25 basis point hike, and we can all move on to July.
Yeah, I think, what's interesting is the markets, we spoke about this a few months ago, right? You know that from a few months ago, since February, we thought that markets was getting overly excited about European growth, firstly, and secondly, about the ECB hiking cycle as a result. Now, just a few months later, we're looking at a technical recession. Interest rate cycle is no longer seen as aggressive as many doubted it. And I think that's pretty much what you would have expected to see at this stage. A 25 basis point hike is pretty much a done deal at this stage. And no changes, of course, expected on the QT side. So, the market's focus will be, I think, purely set on the updated projections to see whether we get any type of downgrades on growth, which is possible. Inflation, we saw a chunky move lower in inflation recently. So there is the off chance that maybe they see some lower inflation projections there as well. So on balance, you've got a higher probability of both lower growth and inflation expectations. So that should probably weigh on their communication from a dovish perspective a little bit. So that's something to keep in mind. For forward guidance, if we can call it forward guidance from them, it's basically just 2 hours of babbling from Lagarde, right? She would rather talk
you about a couple of points for that.
She would rather talk about, anything apart from monetary policy when she's up there, so we're going to be frustrated with what she has to say. Arguably, if she does her job really well tomorrow, she will be as vague as she possibly can in terms of forward guidance. They would want to say just enough, I think, to make sure markets understand that they do want to hike again, or they are very, very, very willing to hike again. But at the same time, they would want to say they would want they won't want to make a pre-commitment to do that either, because they would want to stress data dependency, especially after the recent inflation data that we've seen, and of course the growth data in Germany. So I think with markets already expecting that quarter basis point hike, that's not going to surprise the markets at all. But I do think that those hoping for a surprise, tomorrow might be disappointed. Like I said, if they do their job really well on Thursday, it would make a lot of sense for them to just give the markets enough for the markets to walk out of that and say, what did they actually say? They didn't really say much. We don't really know what they're going to do. Data dependency, but willing to hike. I think we're going to hear the word optionality probably 40 times from Lagarde again tomorrow. And I think that probably sums up the message for what they would be aiming for tomorrow. At least that's what I will be expecting from them. What it means for the euro tomorrow from a tradability perspective, probably not much, to be honest. I mean, I'm still in the market for shorting opportunities on the euro, but timing just hasn't felt right in the last 2 weeks. We closed out our euro shorts 2 weeks ago, and I've been flat on that. I'm not sure whether the ECB will provide the trigger, for a next trade in the euro. I'm just going to stay a bit more patient on this one in the short term.
Yeah, I think I agree with most of what you just said there. Dick, risks to the dovish side, are you in that camp as well?
No.
Oh, what a surprise.
What a surprise.
The world's most hawkish man.
Yeah, Lagarde vegan rambling, a job that she does very well, actually. But I look forward to watching you, Michael, as you listen to her over lunch tomorrow, which I certainly won't be paying any attention to her. I broadly agree with Arno. I think that they'll come out at 25 basis points. She will ramble on and talk about everything apart from her favourite subject, Hermes scarves. Looking at the economies there, industrial production is not brilliant. It's pretty weak. I think the growth is mostly down to Irish growth, which God knows where that's coming from.
Well, hang on a second. We all know where Irish growth is coming from, don't we? Because it's not actually a real statistic.
Is any statistic real in Europe?
True. We're going to talk about China in a minute.
Yeah. That's my first point about China. So, I think industrial production is slowing down. Inflation is going down, but still there. Cucumber prices in Germany have dropped by 75%, you'll be pleased to know. So they're all happy. But to me, just we've got stagflation in Europe. And to be honest, actually, I don't think we're very far away from it in the US and in the UK. I think you'll see 25 basis points, as I said. Whether they will then skip, I know you disagree with me on this. I think they might skip through the summer and come back with something in September. But they will just be vague and rambling again. Whether by September we're starting to get into the winter and people are going to start worrying about fuel, a little bit down on what goes on in Ukraine, but Putin's got to be thinking about squeezing it again. One other point before I stop: the LTRO payments are being called quite soon, aren't they? Whether that will have an effect, I suspect it will. Certainly in our southern friends in the Garlic Belt of Greece, Italy, and Spain may struggle to repay some of those. So that might just dampen things down a little bit. But when you look at the Europe states and the UK, we've all got pretty similar problems. The UK is obviously worse because we've been lagging in terms of raising interest rates. But I just think stagflation's there in Europe.
Well, there we go. Full of optimism once more. An ECB meeting is going to be tedious when we're talking about acronyms and teltros and APP and PEP and all the other nonsense. Ioan, are you seeing things like the rest of the panel, or do you think the ECB could let off a few fireworks, perhaps?
I'm not expecting any fireworks. I mean, like the others. I mean, I think Lagarde will probably communicate hawkishly, and then the staff projections will be more dovish. That'd be quite interesting tomorrow. Those staff projections, especially as headline inflation has been coming down rapidly since it peaked last October. So I mean, that's given some of the hawks on the governing council something to think about or talk about anyway. But interestingly, I mean, the most important indicator that the ECB use for their inflation is the inflation in services, and that fell for the first time since November. So they may interpret this as a sign that the policy tightens are now feeding through into prices. So those new inflation forecasts tomorrow are going to be really key on expectations going forward. I mean, we know that they're on the verge of leaving for the rest of the summer. So, markets are going to probably tail off a little bit until they all come back in September. But like you said, I mean, I think they'll serve up more questions than answers. I'll be keeping an eye on, Eurobond futures. I mean, they're still, peaking at about 3.8% now, with cuts sort of looking to be priced in around mid to late 2024. But what I tend to do is I look more at the lending side of things. I mean, rate hikes now are, they're forcibly feeding through into bank lending. I mean, lending standards, they're highest in the Eurozone since the 2011 crisis. So, I mean, last time I checked, there was a net of around 40% of banks are reporting a decline in credit demand from companies in Q1. I mean, again, that's the biggest share since the GFC. So I think we're getting pretty close to a pause now. And those hawks on the governing council have got a few pieces of ammunition that they can point to, for that pause as well.
Yeah, no, I think you're right. One thing no one's mentioned, so I'm going to give myself a point and a pat on the back for this one, is the sources reports. It's all well and good. We get a decision, we get a statement, we get a press conference, we get the forecasts, but the real meat on the bones of the ECB these days comes about 4:30 in the afternoon when the Bloomberg reporters have rung round all the people who were in the room and tell us what actually happened. Such is the loose, sieve-like way in which the ECB contain their policy discussions. So worth bearing in mind that even though the decision itself and the presser will wrap up about sort of 2:30-ish, the fun may not be over quite that quickly. With any case, let's get on to the last round. Well, Dick, you've whetted our appetite with this one already, saying you want to talk about Chinese data. So we'll come to you first, because all does not appear to be particularly well in the world's second largest economy at the moment. And I'll let you explain why. But the long and the short of it is the data is coming in pretty poor. And of course, that's the data that they're actually giving us. And the government seems to be ramping up more and more stimulus, both in terms of the fiscal and the monetary side of things. So what on earth do you think is going on over there, and how worried should we be about all this?
Well, as I alluded to, I don't think you can believe one number that comes out of China. I think they're always rigged to suit them. So taking that as a starting point, it's really difficult to judge what's going on over there. But it does look like there are one or two problems. I noticed today that they're cutting oil and diesel prices is a way to help the economy. Barclays are now looking for rate cuts every quarter for the first quarter next year. I guess they're going to play around with reserves and whatever. So there is obviously a slight problem over there, or a problem over there, which obviously hurts the rest of the world. What impact that has on Magnificent Seven in the S&P, I don't know. Probably hurts my favourite LVMH shares and Ferrari, etc. And I will get a quick plug into the best wine in the world, Unite there. So I think that there are problems. My real worry is the easiest way out of these problems is for them to cause a confrontation with the US. And I mean an actual war over Taiwan. It may well suit them. It helps unemployment at youth levels. I know it's a really simplistic and awful thing to say. And actually, arguably, it helps the US as well, because a war always stimulates the US economy. So I'm a little bit nervous of what will come out of this in terms of what happens geopolitically, certainly over Taiwan. Although there are times when you can't actually invade Taiwan because of the seas are so rough. I don't know whether we're coming into that area now. So, I don't think everything's great over there. How much it really impacts the States is hard to say, unless that they do become more confrontational. I see that Blinken got knocked down yesterday by the Chinese foreign minister. So they are becoming more confrontational. Whether that's because of the slowdown in the economy, I don't know. But, it's so hard because you just don't know what the truth is.
No, absolutely. And I think that's a really good point. We all know the data's made up. Let's cut the chase. But I think what's interesting, for me at least, is if the data that we're getting is this bad, youth unemployment at a record high, the official manufacturing PMI is well below 50, and exports and imports are both falling, all the rest of it. If that's the official story that they're telling us, and that's pretty ugly, what the hell? How bad is the real story that we assume they're trying to hide from us? That's kind of where my mind would then lead. Is that what you're thinking, Ioan?
Yeah, I mean, it's there's that famous book, was the Myth Busting China's Numbers, and it's well worth a read if you haven't read it before. I mean, they're all made up, to suit their agenda. I mean, yeah. Longer term, we've all seen the headlines of potential stimulus, as a solution to growth. But I mean, the Chinese Politburo, they cling to this sort of GDP target in the 6 to 8% range, and they think that they can do this ad infinitum, led by real estate. I mean, we've long argued that they need to transition to that consumption-driven economy, versus the commodity-driven economy. But again, it's all uneven. You mentioned youth unemployment at 20%, but even that, I mean, consumption still lags anyway. And we've mentioned previously that the savings rate in China is actually really high, of between 40 and 50%. I mean, that's compared to what it is in the US of below 3%. So this in itself is a drag in basic economic terms. But I mean, we've got to come back to that. The birth rate is a problem, and it doesn't really allow for any sort of sustainable demand. Going back to Dick's point about a potential war with Taiwan, where they can sort of ramp up the rhetoric on that to mask the problems that they have at home. I don't know whether that would then expedite the US plan to sort of shift all their supply chains towards India, where I think that's where they'll probably end up going, or Vietnam. These centers of production, maybe they start to get shifted away from China if they can't control their domestic economy itself. But I think the bigger issue here will be that global liquidity, excluding China, is going to deteriorate meaningfully in the second half of this year. I mean, everybody's focused on the Fed QT and refilling the Treasury General account, but I mean, there's going to be declines in the ECB and potential changes for the Bank of Japan's yield curve control. So I would suggest that a lot of this liquidity has been driving US assets as well. So I think there's more at play here, but with regards to China, again, I'm with Dick. I don't think we can believe any sort of number that comes out there. There could be some sort of repercussions on a geopolitical standpoint, so that they can mask concerns at a domestic level.
Yeah, definitely. I think we're all probably in agreement with that. Arno, let's wrap up the show with you quickly. From a market point of view, Chinese equities aren't exactly in great nick. The CNY, or the CNH, however you want to look at it, has been softening quite significantly. Do you reckon this is going to continue?
I think so, mate. Because we've all watched this episode before, right? I think at this stage, yes, in the short term, these moves or these the cuts and the stimulus could provide some support for Chinese equities as well as the yuan. But I think the markets will want to see the made-up data starting to just seem a little bit better for a change. You know, the markets have gone from optimism to pessimism to optimism back to pessimism, all in the scope of 7 months. And I think the market is just getting tired right now, you know, of this China story, because it's the reopening. No, it's not as good. Now it's getting there. Now it's not as bad again. So I think the markets are tired. And I think the reason why we didn't really see a lot of reaction from all of this is because the market says, you know what, fine, we hear you, but let's see the data. Let's see this actually translating into something positive, because we've been hearing them promise all these things over the last few months, and really nothing has happened. Now, I think when it comes to, you know, something like Chinese equities, I think it's important to differentiate between Chinese and US equities right now, because US equities haven't, you know, it hasn't needed Chinese stimulus to rally in recent weeks, right? So I think it's been a one-way train for US equities, regardless of what's happening to China and Chinese equities. So if this does give a boost to Chinese equities, it could be a tailwind for the US. But I think US equities, the story there is a little bit different. In terms of, you know, whether this is worth trading on the Chinese equity side, I don't know. You know, it should be a positive, but again, I think markets are fatigued right now by the China story. I know I am, for one. You know, it seems like every single day, oh, we're going to do this, we're going to do that, and we're going to do this, and then nothing happens, and we don't see the data coming in better. What it means for the dollar yuan, I think, is more interesting, where despite all of these comments, despite everything that happened, I mean, the dollar yuan is currently, you know, we're trading very close to 7-month highs right now. You know, that doesn't seem like the markets are taking this as a positive at all right now. The one thing just to keep in mind, you know, about dollar yuan specifically is, recall back in November last year, October, when we got to that 732 level on the dollar yuan, we saw the PBOC coming up, pushing back against that. So for those who are potentially exposed to this market right now, just be wary that we are getting into those levels where the PBOC got very uncomfortable last year, and that created some downside pressure. So just be cautious of that if you're trading this. But personally, you know, I don't want to touch this with a very, very long stick right now. I would rather just sit on the sidelines. I've got no appetite for trying to make a quick buck on Chinese equities, and the dollar yuan. You know, it's not something that I normally trade anyway.
I think that's sage advice, particularly with the CNY or RMB or whatever, however many acronyms we want to use. You know, when that thing turns, that is going to turn pretty quickly. Well, that brings us to the end of the show. So let's have a look at final scores. Well, I think Dick said he was odds on for the wooden spoon, and so it has proved. Ioan, congratulations. We will, I'll bring you a trophy along to lunch tomorrow.
I might bring Dick a wooden spoon. I don't know.
Thank you.
Well, you need to bring about 4 or 5 at this point. Good stuff. Well, that brings us to the end of the show. Thank you, as always, to the gents for joining me. Dick Matthews from Pardus FX, Arno Venter from down in South Africa, and Ioan Smith as well. Thanks also to Kyriakos, our producer, for bringing this together. We'll be back again this time next week with another show. If you've enjoyed it, leave a like on the video, drop a comment as well, and we will see you then. Thanks for watching, and goodbye for now.